Welcome to Educational Alpha. Kaya CEO and host Bill Kelly brings you on-the-ground conversations with business leaders, educators, coaches, and industry colleagues from around the globe. In this episode, Bill hears from Stefania Di Bartolomeo, founder of Physis Investment and self-prescribed Quant Humanist. Early on, Stefania became the youngest impact investing fund manager in Europe. Since then, she has worked to fill the need for a different level of transparency to answer the next big question: how do we measure the impact of money on the planet? Listen in.
Welcome to the latest edition of Educational Alpha, where the investor's edge starts with informed consent. I'm your host, Bill Kelly, and today I'm joined by Stefania Di Bartolomeo. Stefania, great to see you.
Hello, I'm so happy to be here today. Thank you.
No, pleasure's mine. So I love my job, first and foremost, and I've been at this about 10 years. And what I love most about it is that I've been a sort of a late comer to social media. And I really have just gotten involved maybe since the time I've been at Kai over the last decade. And as maybe an offshoot of that, it leads me to a lot of very interesting people doing very interesting things and a lot of great opportunities. And I think, you can correct me if I'm wrong, we met through this TBLI, Triple Bottom Line, in this World Prize contest where I was part of the jury. And you reached out to me as a result of that. And we had a quick conversation. I said, hey, I think you've got a very interesting story. It would be great to maybe share with our listeners on this sort of not quite a podcast platform. So thank you for that outreach. And maybe start, Stefania, with a little bit of your background so the listeners understand sort of your perspective and where you're coming from.
Absolutely. And Bill, I did reach out because I look at your background and I've always been a huge fan of Kaya. And so I was like, and you live literally next door. So I said, I need to meet Bill. And it's been a little hard over COVID to engage with smart people. So cold outreach sometimes works. And I'm really happy that we're here today. About my background, I like to define myself as a quant humanist. So as someone who has a humanistic approach, but a very strong financial background. So I dedicate my last 15 years to innovative financial technology and ESG, Sustainable Impact Instrument, along with a strong passion for women empowerment. And all of this came to me probably because as I was growing up, I was what people call a tree hugger. I love spending time in the nature. I really felt that we needed to preserve our natural ecosystem. I hated to go swimming or sailing in a polluted water. I hate to breathe polluted air. And I realized that when you want to change something, you also need bright mind, but of course, big capital needs to be moved. And if we don't find a way to move big money to sustainable companies and projects, we're going to keep swimming in polluted water and keep breathing polluted air. So this inner drive of mine made me become the youngest impact investing fund manager in Europe in the capital markets. And then I realized there was an even bigger gap in the industry because while everyone was trying to create portfolios using ESG scores, there was a big need for a different level of transparency to really understand what I say is the next big question in the world of sustainability and in the world of finance in general. How do we measure the impact of money on the planet? So see, I started as a young tree hugger, then I became this quant humanist, and now I am a fintech founder that is trying to answer this next big question. How do we measure with real metrics, not ambiguous ESG score, the impact of money on the planet? And this is the reason why I started Physis, a company, a fintech startup, Boston-based.
So just tell me a little bit about Physis, because we chatted briefly about this, and I use Greek references often myself. I just taught a AI, artificial intelligence, not alternative investment class just yesterday in a boot camp, and I finished my talk with a reference to Hippocrates, because I was talking to data scientists, and I used Hippocrates because he's the father of medicine and created medicine as a profession. This is not a profession. It's a great industry. It's not a profession. I'm urging these newcomers to come in and think about the end client. Think about what it means to be a fiduciary. Think about the environment. Think about the earth, which is probably the ultimate client. So maybe I'm a little bit of a latent tree hugger myself. But tell me about Physis and your Greek reference.
So physis is an ancient Greek word that means everything that's alive on earth. So Physis Investment reinforced the mission of investing by respecting every soul on this planet. As often happens in life, I always had this very strong tech approach, and my parents said, "Oh, you should go and study ancient Greek and Latin." And I was like, "What?" So for 5 years, I spent time reading and studying ancient Greek and Latin, and now they're part of who I am. Physics is a word that comes from the same roots of physis, but means the law of nature. So we are the opposite of the law of nature. We are investing, respecting everything that's alive on earth, but yet we do use techniques that are machine learning, algorithms, and of course AI.
What a helpful background. And I think when we last spoke, I believe it was with you, Stefania, that I made the analogy of ESG versus impact in terms of maybe charitable giving. And if I think about, I grew up in corporate America, and every year, especially in Boston, there was a United Way campaign. And you could give to the United Way, and it was sort of I thought, a lazy approach, because you wrote a check and you felt good about that, but how many cents in the dollar went to a specific cause? And is the United Way marginally better off or substantially better off if I give them $1,000? I suggest it's not going to make a difference at all, and how much of it actually gets to the program, I'm less sure. So I think I equate that to ESG. Impact is if there's a very specific cause. I've got a son with special needs. So to focus on something that's very unique to Max and his needs, that's trying to make a very targeted impact. Is that a fair way to think about impact versus ESG? And is that what you think about at Physis when you think about measuring impact as opposed to broadly measuring ESG, which I think is a very, very hard thing to do?
Let me take a broader approach to this. So I remember when I was in college 15 years ago now, and the word of ESG was non-existent. Nobody knew it, right? We didn't use it. The word of sustainable finance, well, to an extent. There was this concept of ethical investments. So ethical investment was not charity, was not donation, was a way to invest respecting mostly religious investors. As we look at what is happening today, we talk about ESG, we talk about impact, and it's a totally different way of seeing the old world of ethical finance. First, it's not donation. Donation is one thing, is when you give your money away without having any expectation of financial return, which is a very honorable thing. But you don't have any type of financial return expectation. Then there is a concept that has grown in the last few years of ESG. So ESG is a way to assess a company or an investment, adding extra financial information. They go under the E, environment information, under the S, social information, and under the G, governance information. We're talking to expert people here. We probably have always been looking at not just financial metrics, but also some specific extra financial information like governance information, also 5 years ago, 6 years ago, when we were making an investment decision. It's just we didn't call ESG back then. But now this has exploded, and has exploded because we really have seen that extra financial data do have a really strong impact. The problem with the world of the ESG as currently it is today is that we all came to the conclusion that all of this extra financial data point can be summarized into a score. So think about it this way. When we go on Bloomberg, we see all financial data, like different data points, all financial metrics, but Bloomberg doesn't give you a score. Let's take aside the credit score. Doesn't give you a score regarding Nike or Adidas. It just gives you all the possible financial information. The world of ESG, as it is today, is just the opposite. They give you very limited raw basic information, but they give you an ESG score saying that for whatever reason, Nike is better than Adidas. And then different ESG providers provide you different scores, all having very legitimate methodologies. But that's create a huge ambiguity and just doesn't answer the question. If I'm investing in a good ESG company, what is the impact of my money on the planet? So now we get into the world of impact. Impact, just like ESG, has two goals of generating a positive outcome in terms of social and environmental outcome, but also creating a competitive financial return. So totally different again from donation, but you have this goal of creating an impact, and you want to create an impact accessing raw, clear data point. Let me tell you the difference. If I say that Nike has a score of 80 regarding their emission, you are like, oh, okay, 8 out of 100. But if I tell you exactly the amount of emission generated by Nike, then you know what has been the impact of Nike on the planet. So this is how we see at Physis the importance of providing to financial professionals raw impact information.
And so is your goal then, Stefania, to try to measure these very specific impacts as opposed to coming up with a different ESG score than Sustainalytics or MSCI might have?
Exactly. We don't compete, or we don't think that the world in the future is going to keep evolving into creating different ESG scores like MSCI currently provides or Sustainalytics they currently provide. The next big stage of sustainability will be providing a granular access to different impact raw data point to investors so that they can actually compare real information and make smart investment decision. Let's think about an investment strategy. If I want to invest create an investment out of the S&P 500 focusing on gender and women empowerment, I might have, and I want to use raw data point, like number of women hired, new hires that are women, how many women actually made it to managing position or executive position. Those are raw impact data. I can build a new strategy around those data. And that's a totally sustainable impact strategy. But then also out of S&P 500, I want to build another strategy using resource management data. Water use, water recycle, energy use, green energy produce. Then that will give me a different investment universe, still out of the same index. Now, which is more sustainable, the one regarding women empowerment or the strategy that I build regarding resource management? They are both sustainable, it's just a different approach. So this is where the world is going to go on. We need to empower financial professionals, analysts, fund manager, portfolio managers to access objective impact information so they can build advanced strategies and advance our need to move money to sustainable companies and projects. Because again, we live in a world where we are constantly eating fish that has eaten microplastic in the ocean. And I don't want this in the near future, neither I want this for my kids. And I think no one in this room wants it. But if we keep investing into companies that pollute, or we don't give them enough time or resources to transform the business line and strategy, then what is the world of finance going to be in 5 to 10 years? We currently have this opportunity to be unlikely heroes, to really move the needle and building a new world.
Well, I certainly hope you're right on that standpoint. And next time I order fish, I'm going to never think about it the same way perhaps I did before, which is maybe a good thing. If I maybe focusing on the G for a second, and now I'm back to ESG versus impact, but I want to come back to impact as well. If we don't get the G right, I think the E and the S don't stand a chance because you have to have the tone at the top, a management structure, a culture that's focused on good, solid, sustainable governance. So I think that's table stakes. But if we take that as a fact, there's a big difference between governance in a public fund or public equity versus a private equity investment. And I would think on the one hand, the private market is a much better place for impact investing because the capital is more stable and semi-permanent. but there's a lot less transparency. And you've got a GP who has a very limited set of shareholders, and they are limited partners, so there's only so much transparency they have. So maybe if I formulate this into a question, how do you think about measuring impact in the public markets on the one hand and the private markets on the other, and maybe what works well and what works less well if you think about solving, because capital formation and value creation is happening more and more in those private markets.
This is such an interesting point. So, what we see in the capital market is an increase in disclosure regarding extra financial information using specific framework like the GRI, for example. So, companies provide what is called a CSR report, corporate social responsibility report, with tons of information now. The largest the companies, the more the information. I've seen companies with 30 people in their corporate sustainability department. So definitely for them, it's easier, or at least it's now part of their overall business to just create and disclose all of this extra financial information. But disclose doesn't mean that then they are actually very sustainable. So there is a big difference about being capable of disclosing and being an active, sustainable leader. So where I see the difference is that quite often in the private market, we have companies that do not have 30 people. Probably the overall company is 30 people. So for them, it's harder to disclose what they do, but they are way more sustainable for just the way they have built the company culture. Never underestimate what I have seen, especially in the last few years in the private market. The company culture that was shaped by this younger group of CEO and the millennials is much, much better than the old school of the Fortune 500 companies. And those are intangible metrics that are really hard to be disclosed. Additionally, going back, for a smaller company, it's harder to disclose. They don't have those resources. So the best way is probably what is happening in Europe. The regulators are asking also small companies to start reporting. They are not giving them tons of metrics they need to report on, but starting with a few. So I think that the world is going to change in the next 5 years. Private companies will get into the understanding that they do need to report this information to have access to more capital, to disclose what all the good that they're already doing. But we're going to get there. The best way is for those companies to already, almost from inception to grow and scaling stage, start having at least one resource inside the company that can put all of this information into a document. There are plenty of other startups that are helping corporates to report. This is not what we do at Physis. That can also be a solution to access one of those softwares. But again, all of this conversation is happening today. 5 years ago, we couldn't even think about it. So I keep wondering what is going to happen in 5 years. And I'm pretty sure that in 5 years, also the private companies that are really doing great on sustainability, more than they're actually capable of disclosing, will be able to disclose at a very cheaper price.
Well, and I think there's a generational shift in responsibilities, and you've accomplished a lot, and congratulations on that. And I think we're going to see more Stefanias in the role of CIOs at these big asset allocators and sitting at the seat of the pension consultant, and this generational transfer of wealth from my generation, the baby boomer generation, down. You've got this next generation that are much more responsible. And I can tell you, in my 40 years of working in this industry, you're the first quant humanist I've met. And that gives me courage that we're going to get this right. So Stefania, as we move toward wrapping this up, any closing thoughts or observations? I thought this was a very good conversation. I don't know if there's a takeaway around an edge when it comes to education or information that the listener should be thinking about around impact investing.
You touch base on something that the more and more I progress into this role as a CEO, I am realizing. So every time I walk into a room, I am somehow the minority, either because I'm a female or because I'm the youngest person in the room, which is okay. I actually get excited about this, right? But then sometimes when I'm into meetings, people often point out that I am young, which is funny because I'm not even that young anymore. So I see that there must be a way to empower more people, more young women to take the courage to leave their corporate jobs and start their own company. And this is something I'm already doing. I mentor women undergrad that want to have a career in finance, for example. I also mentor other startup at different accelerator programs in the Boston area. But this is something that really needs to happen fast, because change cannot be accomplished by people who have run their business and have a business culture that has led us to where we are today. So I am extremely confident that especially my generation, but even more the new generation, is going to drive this change from an idea to a concrete execution. I can offer myself somehow as a mentor to everyone who wants to reach out. I'm really, really happy to share the up and down of starting your own company, growing and scaling in the US and in Europe. We are active in both countries, and also all the difficulties that sometimes you just might encounter, but also all the great accomplishment that, hard work and persistence can take you to.
Well, I think that's a great advice, and no doubt you are a force for change, a force for good, a force for where we need to be going. And I think the advice that you're just have given to the listeners, particularly women, and we need more women in this industry, particularly anybody that's got an entrepreneurial streak. If you wait too far into your career, you've got other liabilities on your balance sheet to focus on. Your own retirement, buying a house, raising kids, paying tuition bills. And I think taking some of those risks earlier on in your career, I think you've proven that it can work quite well. So thank you for all that you do on both sides of the world. Yes, one last point, Stefania.
Yes, sorry. I also want to really say that change never happens overnight. So we, as industry players, we need to really realize that to move a company in the private market to report will take time. We need to realize that to make sure that Nike or Adidas, just because of two companies that I mentioned before, needs to change their business line into more sustainable ones will take time and resources. And so we need to also realize that probably allowing more and more young entrepreneurs to start their journey will take time, but we cannot stop until everyone really has access to equal opportunities. And probably in the US, we are a little far behind here.
Yeah, and I don't know if it was a Greek philosopher or not, but the saying "patience is a virtue," I think, plays right into what you just said. So, and that's true in life. It's true in investing. Nothing happens in the short term. So, I think a great way to end it. So, Stefania, thank you for reaching out. Thank you for your time today. I did enjoy the conversation.
Thank you. This was really great.
So, Stefania, thank you. And please join us on the next segment of Education Alpha as we look to always put the investor first through transparency, education, and informed consent.